Hello, everyone, and welcome to the Nicola Wealth Real Estate 2022 in Review webcast. My name is Mark Renzoni. I'm on the investment committee for the real estate division, and I'll be moderating today's discussion. Today, we'll be discussing how the Nicola Wealth Real Estate team navigated last year and how their portfolio performed when faced with a number of challenges across the marketplace. Before we dive into the real estate discussion, I'd like to welcome Nicola Wealth CEO, John Nicola, to present a macro overview of 2022 and what's to come in the year ahead. Over to you, John.
Thanks very much for joining us today. It's my pleasure to begin this webinar, this real estate webinar, and to go over first looking at the big picture, the macro things, the macroeconomic issues that are occurring that have an impact on how we choose to invest real estate, and it will show you how it's impacted the returns that our clients have earned historically and what we think it's going to do in terms of how things will turn out over time. So first, let's look at an overview of our presentation today. A few weeks ago, we published a newsletter called Forest for the Trees, and we want to take a look at some macro issues that will not only impact this year, but many years to come in terms of all investment classes, not just real estate. And then take a look at these issues, which are some of the same, but more likely to have an impact during 2023. We'll take also a look at how our strategy in terms of investing, overall investing and asset allocation has performed in this environment. And finally, focus on specifically real estate and segue into a more deeper dive into how our real estate portfolios are managed both here and in the US. See the forest for the trees. Well, we all know how poor the markets were last year. Here's a specific list of some of the world's top equity markets, with the S&P 500 coming in at -19 and NASDAQ -32. TSX much better because of resource stocks at -8. Euro stocks was about 11% down, and the Shanghai index was around 16%. What's more interesting was last year was one of the worst years ever for bonds, far worse than any year since at least the early 1980s. And as a result of that, we take a look, and this is where our clients ended up last year in particular. And we show this because basically we want to indicate that the way one manages one's overall asset allocation makes a big difference in terms of results. So in the red, what you see is the returns are -8.7% for a traditional 60% stock and 40% bond portfolio, assuming that one is investing equities on a global basis with the US and Canada included with international stocks. And as we indicated, the bond part of that portfolio, the 40%, performed very poorly last year. And our average client returns last year were +7.5%. So we're going to examine why that difference took place. Now, as we start 2023, things are starting to look a little different. We might use that old song from the 1930s, from the Great Depression years, "Happy Days Are Here Again," since the S&P 500 is already up within a month at 7% year to date. COVID lockdowns have ended in China. Sanctions are making a difference in the Ukraine war. Short-term rates are at or near peaks, at least in Canada and probably as well in the US. Inflation has probably peaked and it started to slowly decline. And these are the headlines that we're seeing today. So everything looks quite positive. But if I take those same headlines, I could look at it from a glass half empty perspective, like a Eeyore who might say, if I close my eyes, will the mess disappear? So is a recent rally a dead cat bounce? Really an earnings recession is about to come for most companies. What are the US allies' tech war with China? What will that create in a way of divisions in terms of global trade? Let's assume the Ukraine war lasts all of 2023. What are the implications of that? Let's also assume interest rates remain high for the rest of 2023 and do not come down. And inflation remains elevated. In other words, it declines, but it doesn't actually get back to the 2% levels the central banks are looking for. And since we already have an inverted yield curve, which means essentially that short-term rates are higher than longer-term 10-year, 20-year, 30-year bond rates, and that is usually an indication of a recession, is that just a matter of time before that occurs sometime during 2023. So let's go back to this forest for the trees metaphor and take a look at these factors that we see as being significant in terms of the impact, not just on the economy, but in terms of investing. So we start with aging. We take a look at supply chain issues, interest rates, the impact of reshoring, which is also connected to supply chain, of course, and climate change. So start with aging. Almost 50% of the countries, equal to 50% of the world's population, and more than 70% of gross domestic product, global gross domestic products, have negative birth rates. Is aging inflationary or deflationary? We should examine that. What will the impact be on capital markets? As we move forward onto interest rates, the 40-year bull market in bonds ended about a year ago in 2021. Now we have the highest interest rates we've seen since 2007, and they are inflation dependent. But where to from here? When we take a look at supply chain issues, these are geopolitical issues as much as anything else. So the Ukraine war has had a huge impact on food and energy costs and will continue to have that, especially as it relates to food. China conflict with the US, COVID strategy, real estate bubble, and demographics are all issues that are impacting supply chain decisions. Reliability of shipping and manufacturing is a factor as well, which brings us to reshoring. Do you bring your supply closer to where the demand is? You have reduced shipping costs, you have safety of technology, and you have the rule of law. There are significant wage differentials. Mexico is already less expensive, as we'll see in a bit, than China. What about Central and South America as possible winners? Maybe to a lesser degree Canada as well. It's important to note that the Western Hemisphere's population is currently over 1 billion people, so it's also a significant consumer market as well. And then we take a look at climate change. The challenges will be consistency of solar and wind and battery storage. So it's an IT question as much as anything. Nuclear is in play and it's coming back. The question will be, will we have fusion energy within 5 years' time? And Canada might be a winner, and we'll take a brief look at that. It may end up as a result of global warming with a longer growing season and higher food productivity. And fossil fuels, of course, will decline, but they will still persist as part of the global economy. So as we take a look at these factors, interest rates, inflation, recession fears, geopolitics, macroeconomic factors, demographics, and asset allocation decisions, the question is, how will all of these impact the way your portfolio should be built? So let's start with demographics. The aging and population decline are often, if not usually, deflationary. Think of Germany and Japan. So even though the argument is that as people age, they will start to spend down their capital, and that will create a demand for workers in the workforce, and that'll increase wages, which will increase inflation. And that, in theory, sounds logical. But when you take a look at countries that are actually and have been going through an aging issue for decades already, actually the opposite has been what's been observed. Now we're looking at China. The headlines just recently indicated that their last census showed their population dropped by just under 1 million people in 2022. When we look at additional data on China, it's interesting. The Chinese population, one of the problems that China has is that its consumption rate, it's the amount of money that is being spent by the average Chinese citizen on personal goods and services is much, much lower than other developed countries. In the case of China, the average spending per consumer is about half that rate of the G7. In addition to that, the working labor force peaked at about 1 billion people in China in 2012, and it's been dropping ever since. It's dropped by approximately 18 million people just since that time. And their birth rate is significantly below the replacement rate, notwithstanding the implementation of the three-child policy in 2021. So they're now at roughly 1.2, and the replacement rate is 2.1, so significantly below it. This graph really is the one that tells the tale of whether or not the Chinese economy can grow in the future. This is the final consumption expenditure as a percent of GDP of a number of countries, including China. And China, as you can see, is well below the others. This is driven by the Chinese Communist Party reducing the amount of income going to citizens at the expense of focusing on growth that's been driven by exports and infrastructure such as real estate and dams and ports and high-speed trains and a variety of things. China needs to move to a much higher consumption rate if its growth is to continue on a sustainable basis. But the problem with that is politically it's not very attractive because it risks the reduction of power for the Chinese Communist Party. We look at other macroeconomic factors. This massive liquidity was ignited by COVID, which is now starting to dissipate. Our cure, which we already know about, is higher rates and the likelihood of a recession. The inflation may have turned, but probably will take a couple of years to normalize. It's just a very tough environment for all asset classes. And when we look at demographics, we've talked about that most developed nations, I should say, and some developing nations having negative birth rates. The immigration is the only solution to building a population, but it's a zero-sum game. So Canada and the US might benefit, and some parts of Europe, from immigration, but not every country in the world can grow its population by bringing them from another location. So aging and population decline are deflationary for most goods, maybe with the exception of healthcare and travel. Let's look at interest rates. They're going to continue to rise, but perhaps more slowly. Maybe in Canada, there'll currently be a pause to see where inflation goes from this point forward. Negative impact on almost all asset classes, in particular tech, because it increases the discount rate that applies to companies that typically don't pay dividends. Now, how far before the bear market in bonds ends? Well, it's very difficult to say. It is true that right now, medium-term bonds rates have sort of plateaued over the last 2 or 3 months. It's possible that we have already seen the peak, at least in this part of the cycle, for medium to longer-term interest rates. And the impact on the housing market in Canada is going to be significant. Real estate sales were down in October and November of last year in the order of around 40 to 50%, and Toronto very, very much the same thing. So the expectation is that from the peak, which was early 2022 in both cities in Canada, the price drops are likely to be 15% by mid-2023. There is one thing that will make a difference. It was an announcement that our immigration levels are going to increase to 500,000 by 2025, and that pretty well guarantees that we will need 500,000 new homes simply because of immigration over the next 3 to 4 years. So that may be something that stifles how far housing prices will drop. But as you can see here in the US, the average house price has already fallen 12% from, let's say, the middle of the year until roughly November, and those prices have continued to slide slowly, and the numbers are very similar in Canada. Average sold price was minus 12% on a 12-month basis back in November of 2022. This does have a bright side, though, that interest rates have risen, which is one of the causes for the drop in housing prices, but it also means that if you're an investor looking to earn relatively low risk, reasonable returns, these are the yields that you're looking at in a variety of assets, including commercial mortgages around 7 to 7.5%, preferred shares were 6.5% and are tax favored if they're in a non-registered account. Corporate bonds, investment grade, are around 7%. Private debt is over 9%, and all of these are 4% higher than they were 12 months ago. If we take a look at the recession stories, there's been more and more articles about the inevitability of a recession. Growth rates certainly are slowing. We don't have a recession yet, but it is a relatively effective way to deal with inflation. The rate hikes would almost certainly stop if an official recession took place. And at some point, it may be a turning point for acquiring both longer duration bonds and equities. As we look at geopolitical issues here, let's just start with the war in Ukraine. Obviously, the impact on commodity inflation significantly on oil and gas prices, but now it's going to be specifically on wheat and other food products and commodities. Human and financial costs are staggering. Russia is effectively a pariah state. There's still a nuclear threat in terms of how this war plays out. Russia itself is demographically imploding at a faster rate than even China, and its oil and gas revenues because of sanctions are already down over the last year by 150 million US dollars per day, which is roughly around $50 billion per year. On the other side, we have a trade war in tech between China and the US and now Japan and the Netherlands. The world's largest housing bubble in China itself, debt issuance and defaults are very, very high, and the leverage in the Chinese amongst Chinese governments, local and in the national government, are huge. Much lower future for economic growth based on the data we see currently. There's still a rule of law concern in terms of being an external investor. We've discussed demographic issues. The question is, does this make China uninvestable, even though recently their Shanghai and the Hong Kong markets have bounced back from some very low numbers. One of the things for China that's interesting, and this surprised me when I first took a look at this data, is this is a chart of the comparison of labor rates per hour between China and Mexico from the period 2016 to 2020. And as you can see, Mexico has been cheaper than China for at least 7 or 8 years in terms of its labor costs. And so the idea of the US reshoring production that they have in China into Mexico is actually very likely to occur. And even though it'll take years for it to be completed, it will certainly make a significant difference over the long run to Mexico, and will have some impact in terms of China's ability to export to the US. So this is what we would call reshoring. Let's take a look at climate change just for a minute. This is a graph I found showing a variety of areas in the world and just predictions about whether or not they would be negatively impacted or positively impacted by climate change. Basically, the way to look at the global chart here is if you're in the green, and as you can see, Canada is, Russia is in a big way, and many parts of Northern Europe. Global change is a benefit. Global warming is a benefit to you overall in terms of your economy. As you get into the orange, and then the bright orange, and then the red, the numbers are far, far worse. And then the gray areas just haven't been actually measured or analyzed at this point in time. So Canada does sort of stand to be a beneficiary of global warming. The other thing that's an interesting thing is that taking a look at scores is, which companies are having the biggest impact on the reduction of fossil fuel emissions? Well, interestingly, maybe not a total surprise, it's the oil companies themselves that have the biggest impact. So if you're trying to build a portfolio with the idea that you want to reduce the impact of fossil fuels and see significant changes in fossil fuel production, then interestingly, oil companies may be one of the best places to make that decision because of the changes they're making in their energy grids, going and investing huge amounts of money in renewable energies as well. This is a slide from our website which shows beyond stocks and bonds, and this is what our current asset allocation model is. You can see roughly a third in real estate, a third in private capital, and a third in public assets, stocks and bonds. Those numbers change by a few percent each year, but we keep it this way quite closely, and we have done this for roughly the last 25 years. If we take a look at the private equity side of things, this is a chart was put together by Prekin on returns in private equity assets over the last 20 years, and basically since January of 2000. And what you see is that in terms of private equity investments, they pay a lower price, that is a lower multiple of what's called EBITDA or effectively pre-tax income, than you would see in public markets. The gray bars are the Russell 2500, and the blue bars are U.S. private equity. It's an aggregated index. And then if you take a look at all of the other factors, the ones that make a difference in terms of potential future returns, revenue growth, income growth, income margin, and then finally total returns, they're all significantly higher than we would see in public markets. And this is a good example of why we would want some allocation to private equity, because we will get better long-term risk-adjusted returns. In terms of public markets, we have approximately 11 funds, 7 equity, 3 fixed income, and 1 balanced in our portfolio. And what you're looking at here is a comparison with Morningstar database peers, where these are our peers in each category. So based on September 30th, 2022, looking at year-to-date 3-year and 5-year returns, there are 32 possible data points of comparison. In 31 of these data points, our pools were either in the first or second quartile, and in 25 of the data points, they were in the first quartile, which is a really outstanding performance for our overall public pool investment strategies. And now we should look at real estate. Mark Renzoni and Mark Hanna and team will be looking at this in far greater detail than I will here. This is just to give you a framework of the fact that we're managing a little under $9 billion of gross real estate, and roughly through 228 properties located through Canada and the US. These next 3 graphs simply compare how the real estate pools have done when compared, in this case, to the REIT, that's a real estate income trust exchange traded fund for both Canada, the US, and if we take a look at the Canadian one, we see the following. Since 2005, our Canadian real estate pool has earned a 3.1% higher rate of return than the REIT ETF, and it has done so with 82% less volatility than that same ETF. If we take a look at more recent value add real estate portfolio, which is more focused on higher risk in development properties, the gap is wider, as you would expect. The gap is around 10% a year higher return since 2015, so over the last a little less than 8 years. And but the volatility is also about 80% less. And finally, on the US side, what we have is a comparison going back to roughly the beginning of 2010, and the gap is about 3.8% per year more than that is the return of our pool versus the index, and again with roughly an 80% less or lower volatility level. If we take a look at our entire portfolio since January 2000, you can find on our website comparisons with the MSCI World Index, which has averaged about a little under 5% return net of fees since 2000. The S&P 500 in Canadian dollars, the TSX Composite, the Morningstar Neutral Balance Portfolios, which is a blend of investment managers, traditionally around 60% in equities and 40% in bonds. And then this is the return for our average client over the last almost 23 years at 7.04% net of fees. And what that means is, if you started with $1 million in capital, by December 2022, the neutral balance portfolio would be worth $2,650,000, and our average client's accounts would be about $2.3 million higher than that at $4,930,000. So that extra 2.5% a year adds up significantly over a 23-year period of time. A lot of that difference comes during crisis periods like we experienced last year. So we're looking at how our clients fared during the last 3 major crises, starting with the dot-com crash of 2002, where in that single year, the crash lasted 3 years, but in just 2002, 60/40 portfolios were down 7% against minus 2.3 for our average client account. The great financial crisis was far worse. Our average client was down 6.5%, but much better than a minus 14% for balanced portfolios. And last year, our clients were up 7.5%, while balanced portfolios were down 8.7%. So where this kind of asset allocation really makes a difference is when you're in a period of crisis. So we're taking a look at the future. We wrote about 1.5 years ago a newsletter called Born Under a Bad Sign. This was a prediction from some of the world's best money managers about how traditional assets would perform. So this would have been done roughly around the beginning of 2021, so almost 2 years ago. And then BlackRock, JP Morgan, Morningstar, research affiliates, a lot of very, very big names started to look at US equities, developed market equities, emerging market equities, and US bonds, and blending them all together into a single portfolio. And what they came out with was essentially that the average rate of return they expected, this is not including fees or inflation, are shown here, anywhere from 3% for US equities to maybe a high of 6.76% for emerging market equities. And you can see bonds below at 1.33%. So when you add them all together, subtract inflation and fees, and combine them, you get the following: that the average inflation fee IRR for 10 years for the entire portfolio would be 1.28% over the next 10 years. Now, this is 10 years from 2 years ago. Well, as a result of 2022, it's looking even far more likely that these are in fact going to be something close to the 10-year numbers we would expect from 2021. So how do we add value? Well, we look at these three key areas for us, which includes commercial real estate investment, it includes fixed income, private and public, and it includes private and public equity. Now today, the focal point is on one of these, which is where do we add value in terms of commercial real estate investment. And now it's my time to turn this over to Mark Renzoni and Mark Hanna and have them present this to you in greater detail. Thanks very much. Bye-bye.
Thank you, John. This sets the stage for the real estate review. As mentioned, the combined funds of Nicola Wealth's real estate division now represent approximately $8.7 billion in real estate assets. This is across 228 properties, totaling 20 million square feet within Canada and the United States. Today we have Mark Hanna, Managing Director of the Real Estate Division, here to review and discuss the fund's performance and the strategies ahead. We also have Alex Messina, VP of Acquisitions, who will give us his perspectives on the portfolios and future growth as we look at 2023. Mark, some outstanding results last year, even with the economic volatility. Take us through the year-end numbers and update us on the historical performance of these funds.
Thanks, Mark. Hello, everyone. The Q4 reports for 2022 for all three real estate funds were recently emailed to our clients. This chart here highlights the returns for 2022 for each fund up until December 31st, and it also includes the trailing 3-year, 5-year, and since inception returns. 2022 was a very active year once again for our team. We completed 62 acquisitions for a total of $971 million in total transaction volume. In comparison, in the previous year, in 2021, we completed 73 acquisitions for a total of $1.9 billion, by far our biggest year. The primary reason 2022 was lower is that we purposely slowed our acquisition activity in the last half of 2022, primarily due to the rising interest rate environment. So on this slide, you will see the year end for 2022 for the Canadian Income Fund was 13.2%. For the US Fund was 22.7%. And for the Value Add Fund, 19.6%. The next slide highlights the historical annual returns since inception, starting first with the Canadian Income Fund. And all three of these slides will show the annual returns, and it's important to note that the returns are a combination of income and property appreciation. So for Canada, you can see this was the first fund that was started in 2006. It's pretty consistent all the way through. The only exceptions you might see are in sort of stressed years, 2008 and the Great Depression, and then again in 2020 where COVID reared its head. You will also note that 2021 was an exceptionally strong year for the Canadian Income Fund, and that's primarily due to our strategy to significantly grow our Toronto industrial portfolio, which saw tremendous property appreciation and rental growth. Going to the next slide for the US Fund, you will see again very consistent. It started in 2010, and so 2011 was really the first full year. Again, very consistent all the way through. You'll see the average return since inception is 11% and change. And again, the 2022 was its year to shine, and it outperformed. And the primary reason were for two reasons for the U.S. One was our multifamily portfolio and our industrial portfolio, which achieved particularly high income growth. And then finally, we have our value add fund. This was the third fund and started in 2015. Again, very consistent. So what I find very impressive on these historical annual results is the consistency of our returns for all three funds, which speaks to the fund composition for the assets and market selection, which we're going to talk a little bit further about in this webinar. Overall, fantastic results in 2022, and full credit goes to our entire Nicola Wealth Real Estate team who are responsible for these outcomes.
Thanks, Mark. Alex, it's a competitive industry, and your team continues to balance the portfolios with the right mix of assets and across strategic geographies that make sense for your acquisition plans. So can you review the key assets and the key markets that you're active in?
Thanks, Mark. And I want to start off by saying not all funds are created equally. So let's start with our Canadian fund. As you can see, it's very diversified by asset class. However, when you look at our growth, it's really been focused on industrial, self-storage, and multifamily assets. We really like these asset classes because we've experienced strong rental rate growth, and we're bullish that there's more runway to come. If you look at industrial, now represents 37% of our Canadian portfolio. Our self-storage platform has now grown to 8 operating locations, operating under the advanced self-storage platform, and we also have a future location under development in Ontario. A growing part of our strategy has been build-to-own development. Specifically, we're focused on multifamily rental in Vancouver and Victoria, and industrial in the Greater Toronto Area. Let's talk about office. There's been a lot of negative energy around office as an asset class, but I think it's important to note that the office we do own is creative, single-story flex office, which continues to receive strong demand from tenants. We don't actually own any downtown high-rise office, which has been far more impacted by recent trends. So as a result of our growth in other asset classes, our retail and office allocations have come down naturally. We also continue to operate 5 seniors housing communities. Although our occupancy dipped for a short period of time during the pandemic, our portfolio is now back to achieving occupancy of about 95%. Now, in terms of geographic focus, our growth over the last few years has been focused on Toronto, as well as the BC markets of Vancouver, Victoria, and Kelowna. In the last few years, our allocation to Alberta has come down substantially from about 30% to 10%, not because we sold properties, but because we grew in the BC and Ontario markets. And in terms of future markets that we're looking to grow into, Montreal and Ottawa are on the near-term horizon. So let's pivot to our US fund. Multifamily has always been a major part of our strategy. We now own over 20,000 units in the South and Southeast US and have experienced very strong rental growth, particularly last year. Outside of multifamily, the growth in our portfolio has been focused on the industrial asset class, which now accounts for over 20%. Our strategy on industrial is to acquire existing mid and small bay product, as well as developing new product through our build-to-own program, specifically in Phoenix, Las Vegas, and Dallas. So similar to the Canadian fund, the US fund now has a lower allocation to office and retail assets as a result of industrial and multifamily acquisitions. Last year, we expanded into the self-storage space in the US. We are now under construction on 3 facilities in and around the Denver metro that will operate under the Red Rock self-storage brand, and we're really excited to be launching this asset class in the US. In terms of geographic focus, our multifamily assets continue to be concentrated in the South and Southeast in the right-to-work states, where there are no rent controls, and we've seen tremendous population and employment growth. Outside of multifamily, our industrial assets are clustered in 6 major markets: Seattle, Denver, Phoenix, Las Vegas, Dallas, and Minneapolis. We really like these markets because they have low industrial vacancy rates. There's strong population and employment growth trends. They have a diverse economic base, and they're all located along major distribution corridors in the US. And within each specific market, we've identified the nodes that we look to concentrate in. In terms of new markets that we're currently exploring for industrial acquisition opportunities, we're looking at Nashville, Salt Lake City, and Reno. So as you can see, asset class and geographic market selection are very important to deliver strong risk-adjusted returns, and we remain very bullish on the industrial and residential sectors in Canada and the US. A little later on, we'll touch on how these strategies also apply to our value add fund.
These are all strong fundamentals, but let's go further with the discussion for growth in the year ahead. And so, Mark, where do you see continued opportunity for the Canadian and the US funds looking into next year?
As Alex said at the beginning, not all funds are created the same, and that's very true for us. I often get asked by clients, can you speak to us specifically about what your strategies are and the market? So Alex has touched on the market. So I'm going to touch a bit on sort of the actual themes here. And so we continue to evolve over time. And as we learn each year, we continue to get smarter and allows us to make any necessary adjustments to our strategy. So for starting with Canada, here's some themes here. So we have, starting in the top left, we love the small and mid-bay industrial. Usually these are multi-tenanted, gives us a chance to get in at assets that are under market rents where we can roll the rents and have our asset management team update these assets and keep them as in great condition. In the middle, the build to own industrial. This is a big push we've made, both in, we're going to talk about it in the US as well, but certainly in Canada and specifically in Toronto. This is a key market. The vacancy rate is almost zero. We love the mid-bay type product, 200 to 300,000 square feet per building. So we're gonna continue with that strategy. It's proven very well for us. And then moving to the right, we've got multifamily. We are doing build to own, and we're going to talk a bit about that further later on in this webinar about why we're doing build to own. But the multifamily product in Canada, we have to build it to get the kind of returns we're looking for, whereas the US is a little different. We like the new product because you have reduced capex over time. And then going down to the bottom left, we've got self-storage. We love this asset class. It's an alternative asset class. And the key is to have an in-house management team. And we're very fortunate to have a very talented team to help us manage that 9-building portfolio and hopefully growing very quickly across Canada. And then in the middle, creative office. Alex touched on that. We like the low-rise, medium-rise product. It has served well. It did not get impacted during COVID, and we will still continue with this asset class. And then finally, covered land plays. This is really where you've got they're underutilized sites that they're either comprised of office or industrial uses, but there's a much higher and brighter future for this property through higher density down the road. Moving to the in the US fund, again, some similar themes here for the US. So starting with small to mid-bay industrial, very consistent with Canada. We like multi-building, multi-tenanted buildings where we can get in there and work with the tenants and work at growing the rent. In the middle, build to own industrial, very similar strategy. We're doing a lot of this down in Vegas, Phoenix, Dallas, Denver markets. Very low vacancy rates there, and we can get seed market with this product. And the leasing velocity is still very strong for these assets, so they're in strong demand. And then on the right, on the top, we have what we call IOS sites, industrial outside storage sites. I love these because generally they're 1 to 2 tenants. In this particular case, this example is 1 tenant. There's a wash bay, there's a little office building, and then they have a yard area for their vehicles, and they have a yard area for the materials. These are typically in strong infill urban locations where there's high demand from these users. And one day, if we decide that we want to develop a site, this is great for our future development pipeline. But in the interim, they serve us well as an iOS site. And then moving down to the bottom left, again, multifamily. Alex touched on this. We have a very large portfolio in the US. It accounts for 50% of our portfolio in the South and Southeast. There is generally no market rent control, so we're able to really grow the revenue, and they're typically your garden style variety with amenity buildings. This has served us well for many, many years. And then in the middle, we got self-storage. Again, similar to Canada, we're starting to get into this in the U.S. Much more competitive down there, but we've started with Denver. We got 4 that we're building ground up, and then we're going to look to other markets to expand in. And then lastly, covered land play. This picture is actually of a favorite property that we bought a year ago. It's in Seattle, right by Northgate Center, right on the I-5, right on the transit station. It's got 3 small office buildings, but it's on 7 acres, and you can build 2 million square feet of future multifamily products. So again, but in the interim, great holding income, and one day we'll maximize the density on this site. So that's it for the U.S. fund. And Alex, I'm going to turn over you to speak about the value add fund.
Great. And maybe just as a reminder, the purpose of this fund is to create value through ground up development and repositioning opportunities. And everything we do in this fund is on a merchant basis. But similar to the Canadian US funds, you're going to hear some common themes, which are really built around our conviction in the residential and industrial sectors. So again, starting the top left, touching on the industrial theme, one of our favorite strategies is small bay, strata, or condo industrial development. It's been one of our most successful strategies. We've completed over a dozen of these projects. We have several others underway here in BC, as well as our first to come in Ontario. Moving to the right, we also acquire existing small bay industrial properties where we can add value. And our typical strategy involves repainting exteriors and white boxing or modernizing interior units. That way we can push rental rates as units turn over. Last year, we had great success selling 2 industrial sites that we'd originally planned to develop. We ended up receiving unsolicited offers that allowed us to generate significant profit without actually having to take the risk of construction. So going forward, we continually review our portfolio to see where else we can be tactical and sell early to generate a strong return with less risk and move on. On the residential side, multifamily rental development is a big part of our success. Last year, we completed Uplands Terrace in Nanaimo, which is a 100-unit rental project, and it was sold to an institutional buyer. But we also acquire existing multifamily rental product where units can be upgraded as tenants turn over. And finally, in the bottom right, we are now involved in single-family residential development. We are doing this in Ontario, in the Lower Bay, in Orangeville submarkets outside of Toronto with Great Gulf.
So let's talk about the number one issue for the industry, which is interest rates. And it's been a volatile year. And Mark, how has the team moved forward with mitigating this, increase in interest rates?
Yes, Mark, everybody's favorite topic is interest rates. It's in the headlines, and it's what everybody's been talking about for many, many months. So it's no secret that the Bank of Canada was really late to the party to increase interest rates. They really should have started doing this back in the fall of 2021, so call it 14, 15 months ago, but they didn't. Instead, the Bank of Canada waited, but they finally made the move in February of 2020. And if you look at this chart, they proceeded with a very aggressive policy where they implemented 8 interest rate increases over a 12-month period. So back in February of last year, the overnight rate was 25 basis points, and they really couldn't go any lower, otherwise you start to get into negative territory. And then since then, now 12 months later, fast forward to today, the overnight rate is now 4.5 basis points. So that's quite a significant jump, and we're now in an environment where we really have negative, or I would say 0 leverage, as opposed to the previous, say, 15 to 20 years where we were spoiled and we enjoyed having positive leverage. And what I mean by that is 2 to 3% gap between the cap rate and the all-in borrowing rate. That does not exist today for most of the prized assets. Perhaps it does for the challenged assets, but certainly not for the assets that we like. And there's a reason for that, is because those asset classes, such as multifamily, industrial, self-storage, et cetera, are still in high demand. So while the interest rates increases were expected, it was much more rapid than anybody thought, and it caught many off guard. And in the process, it's created a capital squeeze in the real estate market worldwide. And in particular, those companies who elected for floating rates on a majority of their debt, they are now severely impacted, and they will be forced to the sidelines. Our Nicola Wealth Real Estate team, we anticipated the rise of the interest rates 18 months ago, and we proceeded way back in the summer of 2021, because we knew it was coming, to de-risk our debt portfolio by locking in rates well in advance of mortgage maturities, by paying a small penalty and in some cases no penalty to take advantage of that current low interest rate environment. So a common question we're asked by our clients is, what is our exposure to floating debt? Well, I'm happy to say we've paid very close attention to that, to our debt portfolio, and because we adopted a very proactive strategy. So on this slide here, you will see for Canada on the left, you've got your mortgage maturity profile. It's spread out. But the more important thing is 83% of our debt is fixed mortgages, with an average maturity timeline of 3.8 years. And our total debt leverage for the entire portfolio is only 43%. And if you look at on the right side for the U.S. income fund, it's even more impressive. If you look at the maturity profile over the next several years, you can see that there's even less exposure over the coming years, and 96% of the debt in that portfolio is fixed with an average maturity of 6.5 years, and our total leverage is 46%. And as I've said in previous webinars, the primary reason that the leverage is a little higher in the US fund is because we have a higher ratio of multifamily, and with multifamily product, you typically can get higher and more favorable amortization on your debt.
The next issue, and I'll turn it over to you, Alex, is valuations, and a lot of discussion on what we're seeing in the capital markets, especially with the REITs. Can you walk us through, one, the policies around valuation for the platform, and also your perspectives on the REIT market?
Sure, and certainly real estate valuations are a very popular topic right now. So it's no surprise publicly traded REITs were down last year. I think by October, they were trading at a significant discount to their NAV, or in other words, a significant discount to what they report as the underlying value of their real estate. So this begs the question, will private real estate values follow a similar trend? I think it's important to consider the following, that publicly traded REITs inherently have much more volatility than private real estate. Public prices are a reflection of public market sentiment in general. Translation, when there's fear and emotion, public markets react. So in some cases, public pricing diverges widely from the value of the actual real estate. I think we saw a little bit of that last year. Our goal with our real estate funds is to have the funds reflect the fair value of the underlying real estate itself. And we accomplish this by having all of our properties externally valued by third-party appraisers. So our entire portfolio is revalued every quarter to reflect changes in market conditions. And this is also common practice for all institutional real estate investors. What we have seen is that cap rates are moving upwards in our appraisals. However, what we haven't experienced is steep value declines, and that's because we've experienced strong income growth to offset this. And we'll touch on that a little bit later, but this is particularly why we focused on the industrial, multifamily, and self-storage asset classes, because again, we're bullish on the rental rate growth potential.
Mark, in this competitive industry, it takes a winning team, to drive exceptional results, and you have spent years building the Nicola Real Estate division and the team. Can you talk about the team of experts you have on board?
This is the best part of the business is the people, and look at all those pretty faces on the screen there. And unfortunately, there's not enough room to put all 65 faces on there, but our team is mostly based in Vancouver, and with 2 other team members in Toronto and 1 in Seattle. So I'm very privileged to work with all of these talented people. It's a fully integrated platform, and we've got a wide range of disciplines and expertise. And these disciplines include development, asset management, leasing, insurance, acquisition, the debt team, self-storage, and finance. You need this expertise to run the fund of our size. So this is, in my mind, our superpower or our proprietary advantage. Our team strives for high performance. This group is very talented and dedicated to delivering great outcomes for our clients. And as I've stated many times before in webinars, real estate does not run on its own. It requires people who care. And our staff they care. And the other cool thing is that they are invested in our funds alongside our clients, which creates great alignment. Having an experienced team gives us, I think, a distinct advantage with the necessary horsepower to acquire real estate where we can either build to own or acquire existing assets and generate significant value creation. That's what makes this job so fun. Our team is in the office every day. You can feel the energy, and they want to be part of this collaborative and fun environment, and it makes my job really easy. I should also mention that we are very privileged to have many great partners in many markets, and I can't name all the partners because there's too many, and I fear I might miss one and get in trouble. But we have these partners in both the US and Canada who have made a meaningful contribution to our overall growth. And then this picture here is our it's kind of every year we have a pickleball tournament at Hollyburn, and there's our team, and it's a lot of fun. We do that. It's very competitive.
One of the areas that, again, is a question in this current economic time is development, and you can't turn a page in the newspaper these days without some mention that development is slowing. You need a very strong team of experts. Can you talk about your development plans?
Sure. We made the decision several years ago to develop build-to-hold assets for income funds. It's really difficult to acquire a new product at retail pricing and make those acquisitions accretive to our funds. So in order to achieve this goal, we decided to assemble an in-house development team to execute on this strategy. So what Build to Hold allows our Nicola Wealth Real Estate team to create the value, and provided you build the assets, the right assets in the right markets, you can't miss. And so you cannot replicate those same returns if you buy new and shiny at retail pricing. So fast forward to today, we have built and are about to build some very impressive assets that will be complementary to our fund. So this slide illustrates just a few examples of the various asset types, which include multifamily, industrial, self-storage, and office product in the Canadian market.
And Alex, the value add strategies around building stronger income flows, lease rates, tenant occupancy. Can you talk about the team's experience in 2022 and where you're going to focus the team's strength into 2023?
Sure, and I think I want to lead off by just saying that our team is constantly on the hunt for opportunities where we can unlock value. This is a theme I really want to stress. We only acquire assets where there's an opportunity to grow rents. Mark touched on that. And I think this strategy is particularly important in this environment where interest rates are rising. So here's a great example I want to walk through how this works in practice. This is our GTA West industrial portfolio. Over the course of last year, we saw our appraisal cap rates move upwards. However, we were able to increase our net operating income, or more simply, our property level rental rates, by 20%. This increase in rents not only offset the increase in cap rates, it actually increased the value of the property. So growing rents is going to continue to be an important theme we talk about as the rest of the year plays out. In addition to income growth, I also want to touch on leasing and debt because those both play an important strategy to be defensive. And it's important that we always find ways to de-risk our portfolios. So remember, our focus is on maximizing occupancy and cash flow. We've achieved really high occupancy across our portfolios. Our Canadian portfolio is currently at 97%, and our US portfolio is around 93%. However, if we have large vacancies, those would negatively impact both cash flow and valuations. So over the last few years, we identified some of the largest pending lease maturities and proactively completed renewals to de-risk these assets. Here's a few of the larger examples. At 500 Brooksbank in North Vancouver, we completed a 7-year lease extension for a single-tenant office and industrial facility. At Northwoods Business Park, we completed a 60,000 square foot office renewal. And we renewed a logistics user at a cross-dock facility in Surrey for 7 years. The same approach applies to our debt strategy. With low rates over the last few years, we took advantage of this opportunity to refinance assets, particularly where the value has already been created. And again, some of these examples include our advanced self-storage Vancouver location, where we were able to increase occupancy to over 95%. At 880 Avonhead Road, that's a single tenant distribution facility in Mississauga that was constructed as part of our build to own program. We locked in a great long-term rate. And the Rex, a 3-building multifamily complex in Abbotsford, also as part of our build to own program, we were able to secure really attractive CMHC insured financing. Moving on, there's another strategy I'd like to touch on, which is ESG. And as a reminder, ESG refers to our environmental, social, and governance approach. With real estate, we can make an immediate impact on the environment with the investment decisions we make. We can apply this approach to acquiring existing assets as well as developing new ones. So at acquisition, we identify opportunities where we can improve an asset, particularly as it relates to environmental sustainability. Some examples include the addition of EV chargers, transition to LED lighting, retrofitting buildings with more energy efficient heating and cooling systems, and I'm sure there's others. For development projects, we can really tackle sustainability, and we're beginning to use some of the latest technologies to reduce carbon footprints. There's a couple of really interesting examples I want to touch on. One is The Block, which is an office development project in Kelowna. We're using a new smart glass technology that adjusts to sunlight, and this in turn reduces energy consumption for heating and cooling in the building. We're also constructing an office building at Cambie and 7th in Vancouver, and we're looking to use mass timber. Development's great because there's an opportunity to also make a social impact. Mark touched on a site at 2111 Main Street. We acquired this site in 2021, and it used to operate as the City Centre Motor Hotel. This property will eventually be redeveloped with 2 purpose-built multifamily rental towers as part of our build-to-own program. However, as an interim use, we've created spaces for artist studios, and the property actually hosted the Vancouver Mural Fest last year. So as we grow our portfolio through development, we want to provide amenities that will continue to enhance our communities. Our ESG strategy is now off the ground and running, but our goal is to become a leader in this area.
As we wrap up, let's talk about the challenges and opportunities as we look forward to 2023. And Alex, we'll start with your perspective of the challenges. You see this every day, and over to you to highlight what's on your radar screen in 2023.
Well, we know we're in a more challenging environment now than we were 12 months ago. Hindsight, I guess, truly is 2020. And from our perspective, the key challenges are debt market volatility. Interest rates have gone up, bond rates have bounced around in the past year. This has made it really challenging to underwrite new acquisitions with confidence. Inflation continues to lead the headlines. We've seen this impact construction costs. This in turn puts pressure on development pro formas. And there's also the potential for leasing activity slowdown. We've had really strong leasing activity over the past 18 months, but if there is a slowdown, we could see occupancy rates start to fall. So Mark, why don't you actually tell us why the glass is half full?
Yeah, I get to do the fun part. I'm actually quite optimistic about the future, and I do see some great opportunities for us. Firstly, many groups are capital constrained. There's a squeeze. So over the next 6 months, we see opportunities to acquire either existing and our future development sites that where we can step in at favorable pricing and take those projects over and be very accretive to our fund. And secondly, due to this capital constraint, only the strong will survive and can proceed, which in my mind results in less competition and opens up more options for our team. And then thirdly, the volume of new developments will be paused, helping reduce the supply, which again, it works in our favor. So where we have a distinct advantage is that we have an experienced team that can do the deep dive on market intelligence and due diligence when considering acquiring certain assets, and having also the discipline knowing when to pull back if necessary.
Well, let's sum up, and we'd all like to hear, Mark, your projections for the funds for 2023.
Projections. Okay. Well, we're obviously coming off a record year in 2022 for overall returns. I would love to say we're going to beat that, but we've got to be realistic. We typically are always conservative when providing return projections. For 2023, we're projecting our three funds will be somewhere in the mid to high single-digit returns, which is still very acceptable and much closer to our historical averages we showed on those earlier slides. There's no question that cap rates have started to rise. We've seen that over the last 4 or 5 months. But what's really impressive is that the income growth remains strong, especially for the assets we favor, such as multifamily, industrial, and self-storage. And that is helping to serve as a great counterbalance to rising cap rates. We remain really bullish on the fund composition strategy that Alex outlined for the asset type and the market selection. We're optimistic that the suggested pausing of the interest rate hikes by both the Bank of Canada and the US Fed Reserve will give ample time to measure the impact on inflation, which I think all of us are relieved to hear. Real estate has proven over time to be very resilient, as shown on our historical annual returns for all three funds. There's a lot of capital on the sidelines waiting to jump back in. We are excited about the prospect of sourcing value-add opportunities in this environment where we can make a material impact that will be accretive to our overall fund returns. There's definitely going to be a flight to quality on partner selection who have consistently produced. Strong relationships with our lenders will be more important than ever, and we are privileged to have earned a strong reputation within the lender community. We are well positioned with our lease maturity and mortgage expiry profile, as indicated on earlier slides, and we're well diversified for both of our income funds. So overall, we're optimistic about the opportunities that lie ahead, notwithstanding all the noise in the media.
Thank you, Mark and Alex. This concludes our presentation today. And Mark, where can our clients go for additional information?
Yes, you can go to our website, which is just being relaunched, and the new and upgraded version. But you can go to the website at realestate.nicolawealth.com. It features announcements and press releases on recent acquisitions and other noteworthy milestones. And it also contains all our quarterly reports and includes also our past webinars. And finally, a summary of all our assets and the markets we are invested in.
Thank you, everyone. Have a great day.